Good evening, everyone, to the Pension Fund Advisory panel meeting today. It's in two parts, and before we start, my name's Lakshmi Attawa. I'm the new chair of Councillor for Collieswood. I'm the new chair of the pension scheme, and as I don't know anyone, it'd probably be a good idea for us to introduce each other. So, shall I? I don't know how to go around.
Should I go next?
Adam.
Sure, yeah. Hi, Councillor Adam Bush, Vice Chair, been sitting on this committee since 2014 now. I think you might be our fourth or fifth chair now. But hoping for a smooth transition.
Okay. And Tobin?
Councillor Tobin Byers. I'm Cabinet Member for Finance as of 2 weeks ago and new to the Pensions Committee too.
Okay. Caroline?
I'm Caroline Holland. I'm the Director of Corporate Services and Section 151 Officer for the London Borough of Merton.
And good evening, I'm Roger Kershaw, AD Resources, Merton.
Okay. Nimashe?
Nimashi Sivayogan, Head of Treasury and Pensions, look after the operation of the pension fund investment and pension admin.
Okay. Aniket?
Good evening, everyone. I'm Aniket Baduri, the investment consultant from Mercer.
Barry?
Hi, good evening, everyone. I'm Barry Mackay. I'm the fund actuary from Barnet Worthing.
Right. Is it Julie, is there, or is she going to talk?
Hi everyone, I'm Julie Bailey. I'm also an actuary from Barnet Worthing.
And we've got other members of staff as well, Liz Hammond and Gary Wells and Amy, who's administering the thing. So, are there any apologies for absence?
Yeah, I can't see the staff representative from the unions, Tina Picard and Gwen Isaac, and
all right.
I didn't receive any apologies in advance. I think probably we'll take it as the apology.
Okay, are there any members' declaration of interest? Okay.
No.
Has everyone, are there minutes of the last meeting? Does anybody have any comments to make on it, or they're happy with it the way it is?
No.
Chair, yeah, no, approve them. They're a true reflection of the meeting.
Okay, thank you. And agenda item number 3, the quarterly fund performance review. I'll hand over to Roger Kershaw to
Thank you very much, Chair. Thank you. I'm taking the report as read, and obviously this is the public part of it. But in summary, overall, the fund grew by some £30 million in the last quarter to September 2020, primarily due to our equity performance, where we remain overweight as we wait for drawdown for our new mandates, such as things like property and infrastructure and private credit. So that's a positive performance that we've achieved in somewhat difficult times. And this represents a 3.8% return against our target of 1.2% over the 12 months over this period. And over the last 12 months, the fund performance was some 5.3%, and our 3-year annualized performance was 6.8%. So our annual performance target, for information, is 4.8%. So overall, the fund continues to add value and is in a favourable position. Obviously, there's detail in here with regards to individual performance, which we will go into in part 2 of our meeting. But in terms of the part 1 of the meeting, that's my introduction. Chair, happy to take any questions.
Okay, thank you very much. Does anybody have any comments or questions on the report? Okay. Then on to item 4, update on the pensions regulation by, is it Barry McKay or Julie Bailey who are going to be speaking to it?
Thanks, Chair. I'll speak to the report. I've also prepared some slides, which is a presentation that's going to talk through. Hopefully, for a chance to read the report. But if we just click on to page 17, I think, of your papers.
Yeah.
So
yeah.
the stuff I'm going to cover tonight is where we recap of the 2019 valuation. Obviously, a lot has happened since 31st March 2019. So I was going to give you an update on where the fund is now to reassure you. I just heard from Roger that things are still going well. The fund's bounced back. So I'll look at, that's the asset side. I'll look at the liability side as well to see where the fund is at current date, and also some stuff around life expectancy and so on, which is obviously a big issue at the moment. And then I'll talk a bit about the consultations that have come out and potential changes to the regulations in the LGPS. There seems to have been a whole raft of them over the summer. I'm not sure why the government have been so busy. I thought they'd have other things to do, but they've certainly been putting out lots of consultations and that will impact the LGPS, the administrative authority, the fund, the employers and the members. So we'll talk through some of those. Hopefully, as I say, you have a chance to read the report and you're familiar with some of those issues. So on page 18, this is just a recap of where the fund was as at the last formal funding valuation date of 31st March 2019. Very healthy position, showing the funding level is 103%, which means you had slightly more assets than the value we placed on the liabilities, the benefits that you're going to have to pay out. So £718 million of assets at that point in time against the value of the benefits you're going to have to pay out in the future, which is 698 million. So a small surplus of 20 million, which was an improvement on the 2016 position, where the funding level was 94%, and there was a bit of a deficit. There was a deficit of 33 million at that point. Both the liabilities and the assets have grown, of course, over that period, but the assets doing better, so that's good news. On to page 19, I think, of your report. I've already probably talked about this, what's happened since. Lots, markets have been all over the place, and I'm sure you've been keeping a close eye on that. In a bit more detail, what I will cover tonight is there's been a number of consultations, as I said earlier, but the three main ones at the moment are McLeod, the 95k exit cap, which is in fact taking up everyone's time and is probably the biggest priority at the moment, and a bit around employer flexibilities of managing employer exits and so on, which we'll come on to all of that shortly. So the market volatility, as you can see, has been significant. This chart on page 20 shows the returns on equities, which is the yellow line, and the return on gilts, which is the green line. So if that's not your fund, that's just the general markets since 31st March 2019. So no surprise, they were fairly volatile anyway, for a number of reasons, Brexit and all the rest of it. And then, of course, COVID appeared and the markets plummeted for around 6 weeks between towards the end of February and the end of March. But they bounced back fairly strongly, actually, and probably by the end of May, they'd regained most of what they had lost, particularly equities and gilts here. So what this chart shows is the sort of straight line that's, I'm colourblind, but I think it's kind of grey. The straight line that goes through the middle, that's the interest on the liabilities. So that's the assumption that they actually made, we made, that your investments is to try and at least keep pace with, so the assets would keep pace with the liabilities. And over that year and a half, that's been around 7% but in fact, your actual assets, which is the blue line, have returned. I did these slides before I saw the investment report, so I had to estimate a bit of the return, but I thought it was around 12%. In fact, I think it's a bit higher than that. So since 31st March 2019 to 30th September 20, I think you've probably returned a little bit higher than that, maybe closer to 14%. But anyway, the point of this chart is that your actual assets have outperformed the assumption that we made for future investment returns. So that's a good thing, obviously, because that'll increase the assets more than the liabilities. The other things that have happened is because of volatility in the markets and so on, and what we think might happen in the future, our expectation of future investment returns has come down. So we probably, if we're doing evaluation today, the return might be around 0.6% less than we used at the valuation, and what that does is it pushes the value placed in liabilities up the way. However, inflation, the long-term expectation of inflation has also come down, and so that dampens down that increase in the liabilities a little bit. So putting all that together, as I say, I think at this time when I made up this chart, my estimate was that the assets has gone up by about 12%, and the liabilities has actually gone up by about 12% once you take into account the interest and this change in assumptions. So the fund level was broadly unchanged. Having seen the investment report and those actual assets, I think, doing slightly better, your fund's assets doing a bit better, then it's likely the fund level is actually up slightly. So it might be somewhere around about 105 or so on. So that's good. Not been in the room, it always makes this more difficult, so I should probably pause and ask if anybody's got any questions on that before we move on to the next part.
Barry, quick question. So the GMP equalization, that's obviously, I believe there was a bit more sort of news that had come out last week or something in terms of the sort of banking case. Is this something that's going to be sort of now more looked at sort of within the next few years, and will there be a figure that will be then disclosed in the accounts?
So the ruling, I think it was only very recently that the next part came out. It kind of broke in the news yesterday. That doesn't actually impact the LGPS. Lloyd's ruling didn't impact the LGPS, and the part that came out yesterday was a lot around transfers and so on. That was the main kind of finding from the case, because the LGPS participate in what's known as a club transfer, and because the HMT said that the original Lloyd's ruling or Lloyd's case wouldn't impact the LGPS, we don't think that this is an impact on the LGPS, so that's kind of the good news. The second part of the good news is that we've already, in our assumptions, we've already kind of allowed for any indexation changes, so we've kind of baked that in as well. There might still be some complications around equalisation because of the different state pension ages that applied for a while in the LGPS, but the government kind of keep kicking the can down the road on that one for public sector schemes, so we don't have anything definitive on that yet. But the good news is that I think the majority of what might happen or might change is already taken care of for you. But yeah, it's a good point, and it's another consultation that's out there, which I haven't covered tonight, just in this interest of time. But yeah, it's going to be a lot of work for a lot of schemes. Sorry, anything else before I move on?
One else question? No, carry on.
Okay, so if I go on to page 21, this isn't your fund. This is just a general picture of deaths in the UK, and what this shows is the green bars and plus the blue bars are the total number of weekly deaths since the start of the year, unfortunately. The dashed line is the 5-year average. And so the green part of the bars are deaths not involving COVID, they're not related to COVID, and the blue part on top is. And obviously, again, unsurprisingly, there's a big spike at the end of March into April when COVID started kicking in. And then we got it under control to some extent. I think the two interesting aspects about this chart is, again, towards the end of this one, so the end of October, we can see the blue bars begin to appear again. And so the number of cases clicking up, which again might not be a surprise, but the good news is that we seem to be either treating it more quickly or more effectively and getting it under control more quickly, because there's nowhere near the same spike as you can see back towards the end of March. The second element, that being a sad actuary, that I find interesting about this chart is, before COVID appeared, before we knew anything about it, the number of deaths, so just the green bars towards January, February and early March, was generally below the 5-year average. And so if we do get COVID under control, hopefully, and the pandemic passes, the question is, because we're always looking to the long term, we're interested in 10, 20, 30 years from now, and we're trying to make assumptions on that basis. Does that earlier part of the year, assuming we get a vaccine for COVID and everyone is safe, does that imply that life expectancy is maybe ticking up a bit again? Now, there's probably not enough data there yet, and it's probably too soon to say, but just something to be aware of that might kick in at the 2022 valuation, for example. So another other thing I think to say about that is that chart is at the peak, that you can see the green bar being quite a bit higher than the dashed line, and that's just because there's probably quite a number of deaths that were not recorded as COVID, but were probably very likely to be indirectly related. So people not being able to turn up for treatments and not getting taxed in emergencies and so on. So that's probably why that explains that effect. So to bring all that together, the point for the pension fund is that it's probably still too early to say how this might all pan out in terms of the liabilities. Obviously, there could be a few more deaths than expected, and that dampens, that pushes liabilities down. But it's probably going to be quite small in the scheme of things. So although it's, you can't get away from it, it's in the news every day, it's probably not a big impact on the pension scheme so far. Okay. I don't know if there's anything on that, or move on.
No.
So page 22 is just a picture of a bus, because you wait for one consultation for ages, just like a bus, then you get a whole number that come along at the same time. I think we've got 3 here. GMP's already been mentioned. We've got the Goodwin case. They're certainly keeping everyone busy, and the LGPS and the public sector schemes. The first one I'm going to look at on page 23 is the McLeod Sargent case, which hopefully you know a bit about this. It's the age discriminatory case. And what happened was, when Lord Hutton made recommendations about changing the LGPS and other public sector schemes to a career average, he did say you need to be careful of any age discrimination by when you change the scheme. Unfortunately, the government didn't pay too much attention to that, and in the LGPS in particular, they put in, to be fair, they were trying to do the right thing. They put in a 10-year transitional protection. So for those members within 10 years of retirement, they would receive the higher pension of the 2008 final salary scheme and the 2014 career average scheme. And the idea was, if you're close to retirement and you'd planned for your retirement, then it wouldn't impact those plans. Unfortunately, that's been found to be discriminatory on the grounds of age, because if you're 54, say, and you're 11 years from retirement, you're not covered, but if you're 55, you are. So clearly it was disadvantaging those younger members. So they have proposed a new underpin, and what that is, a new remedy, and what that does is it extends to all members who were in the scheme on 31st March 2012 and who also accrued benefits in the 2014 scheme. Okay, and the underpin will apply for those 8 years from 2014 to 2022, and the 22 relevance is that's when the 10 years would have ran out if you'd been 10 years from retirement in 2012. So there's 8 years of benefit now where the fund will need to compare the final salary benefit and the care benefit, and the member will get the higher of those, as I said. And I'll come on to that in a bit more detail on the next page, next slide. But just about on the impact to the fund. Now, the Government Action Department estimated that this would add about £2.5 billion to the cost of the LGPS, which sounds like a lot of money, and it is, but it's only about 0.8% of the total liabilities across the scheme. The second thing is that they used a fairly optimistic assumption for pay growth, and as we'll see in a second, this underpin is very sensitive to that assumption. So the Government Action Department used a salary increase of 2.25% above CPI. Now, for your funding valuation in 2019, we used CPI plus 1%, so quite a bit less than the government than GAD used. So in fact, we think that instead of the 0.8% increase in liabilities, if the 1% pay growth assumption, real pay growth assumption, pans out, then it will only increase liabilities by around 0.3% of pay. It will, of course, have an impact on the future service cost as well. And so overall, we think it might add around 0.5% of pay to the contributions that the employers are paying. Now, that's across the fund as a whole, but it will be quite different for different employers. And I'll explain a bit more about that in a second. And the main problem here actually is it's not really around the funding as such or the actuarial issues. It's around administration and the issues around the work required to put this right, because the funds will need to go back and correct data. They'll need to collect historic data back to 2004. They'll need to carry out the underpin calculations and so on. So there's a lot to do. And in fact, the administration may end up costing more than the remedy, which is a bit ironic. If I go on to page 24, you should have another chart in front of you, bar chart. So just to explain what we've got here, this is looking at a member with a salary of £30,000 at 2014. And the green and blue bars are just the final salary benefit accruing, but based on different salary increase assumptions. So green is CPI plus 0.5%, the dark blue is CPI plus 1%, and the light blue is CPI plus 2%, which is closer to the GAD assumption. And the red bar is just the care scheme. So what we see here is if a typical member has only got 5 years of service, then pretty much the care benefit, the benefit on the career average revalued earnings scheme, is always going to be higher. Almost doesn't matter what the salary growth is, unless they got promotional increases. And the reason for that is the accrual rate of the care scheme is 1/49th, and the accrual rate of the final salary scheme is 1/60th. So there's a 20% improvement, if you like, going from final salary to care, and it's going to take quite a lot of time to make up that gap. So you need to be getting significant salary increases and ahead of CPI to catch up that 20%. So what we see as we move from left to right is, in fact, that starts to happen because the younger members in this case, will have had to be in the scheme for quite a long time, because the final salary they use when they come to calculate the benefit when the member retires or leaves is linked to, sorry, the final salary pension is linked to final salary at that point. So if we take the middle one, for example, and there's a member been in for 20 years post 2014, and they've been getting 2% per annum more than CPI every year, then that 2% compounds up over 20 years and starts to outweigh the accrual rate. So you can see in that case, that member actually receives a higher benefit under the final salary scheme than under the care scheme. And this is why I mentioned you might get quite different impacts for different types of employers. So if you had an employer with a very young group of employees who stay in the scheme for a long time, they could be in this in that boat where the final salary benefit becomes more valuable, and vice versa. If you've got a lot of older employees, they're not going to have time for the salary increases to outpace the accrual rate, and therefore it's not really of any impact on them. That's kind of quite complicated, but hopefully it gets across the message that it benefits younger members, and therefore there could be different impacts on employers. The other thing I guess to say is that it also changes or is impacted by the rate of people leaving. So if you get lots of turnover of staff, they lose their final salary link, and therefore they're not going to get that build up of final salary benefit. So if you get high turnover of staff, it's not going to impact those types of employers either. But we'll come to do all those calculations at the next valuation at 2022. Okay, so that's McLeod and the impact on members potentially. Any questions on that?
Barry, can we assume that members have read everything so we go through this fairly quickly?
Yeah, I've only 2 bits to go, so it won't take too long now.
Okay.
Very quickly, so we move on to 95k cap on page 25. The objective of this was to avoid 6-figure redundancy packages. That was kind of the point. But it seems to have grown arms and legs, and therefore it's going to impact almost all members. And that middle box there again, the Government Actions Department have done some numbers, and they think anyone out of all those been made redundant, 86% will be impacted, which is quite precise. So assuming you've read the paper without going into all the detail, I'll skip on to page 26, which is a table that shows how this impacts a member aged 56 who's on pay of 60,000 as 20 years service. Now I won't go into all the details here. It's deliberately busy, this slide, to show you how complicated this is. So you can imagine sending this out to a member and saying, here's all your options. It's going to be a very difficult communication exercise, I think. So just very quickly, I'll compare two columns. The first column is what the member would have received before the 95k cap came in. So they have a full pension payable immediately. They'd have statutory redundancy pay, and they might have a discretionary payment as well. And the total value of that package would have been 159,000. What would happen now is the member would have one of 4 options. So either they'll have to lose their lump sum, the statutory redundancy pay, and or they'll have to take a reduced pension, or they'll have to pay some money in to keep their full pension. So it's very complicated, and I've kind of circled the parts there that change each time. But I guess you can see if the member takes a fully reduced pension, the 4th column along, the exit package is only worth 34,000, so a huge difference. And so lastly, page 27, the third consultation around employer flexibilities. And this just splits into 3 areas. And one of the reasons behind this is they're trying to TPR and so on, trying to bring covenant into it a bit more, and so look at contribution reviews more regularly if and when you need to. The second element is sort of well-known problem of employers having said the LGPS is too expensive to stay in and it's too expensive to get out. And so if they do leave, they're now allowing them to either spread exit payments over a period of time rather than ask it for a one-off lump sum, or they're allowing them to continue participation without triggering a debt, and therefore which is called a deferred debt arrangement, and therefore that keeps the risk with the employer because the debt may go up or down depending on what happens in the future. And so lastly, page 28, that's just factors that the fund will need to consider of this employer flexibility consultation that's out at the moment. So again, quite a lot for funds to think about, and they'll need to have a policy in place to decide when to apply some of these things, and we're happy to support the fund in drafting that policy and communicating to employers. So on that note, I'll finish there, but happy to take any more questions.
Barry, I have one question. On the 95 cap, how is impact the employers? Because the pension strain, how much we have to pay, the employer have to pay into the pension fund will differ based on the option. Overall, are you able to give some idea what is the impact for the employer?
Yeah, so well, once again, it's complicated by having what's known as capped employers and what's known as uncapped employers. So capped employers will never have to pay more than the 95,000 to make up that gap, because the member's effectively taking some of the hit now. So that'll be the maximum they pay. For uncapped employers, unfortunately, because members aren't capped, they will still pay effectively what they're currently paying now. So we would calculate the strain cost, come the valuation under the funding assumption, and they end up paying whatever that might be, because the members received a full immediate unreduced pension effectively.
Okay. Thank you.
So it helps employers, but not members, this one.
Yeah, that's the thing.
Barry, just because obviously the scheme was in surplus or near enough sort of surplus at obviously the previous valuation, which was sort of pre-COVID. Presume obviously maybe at the next valuation date, obviously still a bit sort of I think it's about 2 more years to go or something. Are we sort of looking at potentially maybe still keeping the recovery plan at a shorter period? So sort of is obviously the target to keep on exceeding that 100%. So there isn't, so sort of 5 years down the line, if there is another pandemic or difficulties, there isn't that reliance on as the council's funds.
Yeah, I think that's sensible. Absolutely. So you'd want to continue to target a bit higher than 100%, just because of the sorts of market falls and so on we experienced earlier in the year, and that guards against, you effectively get a bit of a reserve to guard against those. And the other thing we do is we smooth the smooth the results to kind of try and reduce some of that variability when it comes into the contribution rate, so the council contribution rate isn't bouncing around all over the place from one valuation to the next. So we try and keep them as stable as possible. But yeah, I think that'd be a sensible thing to do, aim for 105% or whatever funding level.
Thank you.
All right. Any more? Does anyone else have any questions to ask? All right. Is there, okay, and the next item is, are there any is there any other business?
No, nothing from us. So.
No.
Chair,
Yeah.
this is obviously the public
Yeah, so then
part of the meeting. Yeah. Okay. Yeah, so my
Yeah.
other point I'll raise in the other section.
okay. So what do we do? Do we just move on to the next section? We close off this.
If you make your announcement, then we will move to the
Yeah.
part 2.
Okay, so we are excluding the public for the next session of this meeting.
Yes.